Hi everybody, this is Elena here. We're at Tai Lopez's place and this is Mike. He does private equity for businesses and has really creative and innovative ways to help businesses grow.
So one of the things that we were talking about a little earlier was, how do we really make a company grow? And you can either grow organically or you can grow through acquisition. So we really got into talking about that earlier. So you asked me to share about that. And so let me just take a couple minutes and explain what I mean when we help a company grow by acquisition. So a very famous way of really growing is to actually do an IPO. Now, not an IPO that most people think about like Facebook or Google, but more like what Berkshire Hathaway or Burger King have done, which is to do something that's called a reverse merger. In a reverse merger, all you're doing is you're finding a company that's already listed on a stock exchange, whether it's the American Stock Exchange, Australian, Chinese, the UK, whatever it is, all these different exchanges. You can actually find a company that's already publicly traded. It's sitting there, but it does no business. So it has shares and just sits there. And we can actually go buy that company. It's called a shell. We buy that company, and then we take the company that we own, and we actually merge the two of them together, and now all of a sudden we're publicly traded. So it's really just that simple. And what's great about a reverse merger is it's about a tenth of the cost and about a tenth of the time to actually go public. Now, the best part about that, and you might say, well, I don't want to go public. Why do I want to do that? And it's all about valuation. So a company that might be worth $10 million today as a privately held company, the moment that it goes public, instead of it being worth, let's say, 4, 5, 6 multiple on its earnings, all of a sudden it might now be worth 20, 30, or 40 times, 24 hours later, simply because it went public. Now, the best part about that, not just because it has value, the valuation, is I can now use that company's stock to go buy other companies. So when I first started and we started this conversation, it was how do we really grow a company quickly? And it's about not growing organically or internally. It's about how do we really make the company explode? And that's by buying our competitors or buying other companies that are similar to us that have a cash flow. Because now I can use a company that's now valued at a 40 multiple. I can then go buy a company that's valued at a 5 multiple. So essentially I get to buy it at a discount. So all of a sudden it becomes much cheaper. So it's much faster for me to use my stock then and go buy everybody else and grow the company that way. So for every dollar that I bring in on a company that we buy, it isn't worth, if it had a valuation of let's say 5, it's not worth 5, it's now worth $40. So instead of $5 multiple because it's privately held, it's now worth $40. So the valuation goes way up, and then the more, of course, my stock goes up, the more valuable my stock becomes and the cheaper my competitors become for me to buy them.
Wonderful. And Mike told me he has 50 companies under your portfolio currently, correct?
Well, we've done 50 different IPOs, and on average we'll have somewhere between 20 and 30 companies that we're buying, growing, and then ultimately reselling. So we'll have a whole bunch of companies at any given time.
And he's doing this international as well.
Correct. So yeah, we'll do deals in Australia, UK, Russia, South Africa, Chile, Peru, Colombia, Costa Rica, Mexico, all of the United States, and Canada.
And how long has your company been doing this for?
I've been doing one iteration of it or another for about 30 years.
30 years.
Right.
Great. And I think the 4 things that you wanted to talk about, how you help the company grow.
So, right. So every company gets stuck in one of 4 ways. That's people, marketing, systems, and money. Now everybody thinks, and if I ask somebody, I say, well, how would you grow your company? What do you need to grow the company? Everybody always says, I need money. So they want money so that they can invest in automation, or they can invest in the right kind of people, hire the right kind of people to make the company grow, or they want to improve the market. So they all think that they need money in order to do all these things. Really what they're asking for is they want my money to test their idea to see if it's going to work. What I'd rather do instead is ignore the money, and let's focus on the marketing, the people, and the systems, or the automation, and with automation at scale. So people think if I get money, I'll then get the automation, and then I'll bring the people in to manage the automation, and then once I have that, then I'll increase my marketing. They go about it backwards. If you fix the marketing first, and then you hire the right people to implement the marketing, they will then implement the automation or the scaling that allows the business to grow, and that frees up the money. So most companies go about it the wrong way. So anytime I look at a company that we want to either partner with or grow, because our model is to go in, find companies that we can at least triple the net profit, and then we want to resell. That's our model. Now, there are companies that we'll buy and we'll just hold because they just throw off lots of cash, and sometimes that makes sense. But every company that we've ever worked with, they always get stuck in one of those 4 areas. And most companies go about it wrong because they want the money first because that's what they think will solve it. And they go for the automation and people in the marketing. But if we fix the marketing first, then we go for the people, and then we go for the automation, it frees up the money. So it makes it pretty simple.
And you said about companies going public. Some companies, they're just like, okay, I'm going to use the $1 million way or the merger way, which is...
Well, so you could do 2 different types of going public, right? One is the Facebook or / Google way, which can be a $200 or $300 million IPO, but they're trying to raise a lot of cash that they want to then invest. That's one strategy. It's very expensive, very time consuming. A simpler strategy is doing the reverse merger where we buy that public shell, we merge our existing company into that, and now all of a sudden we then use our stock to go buy others. So rather than generate a lot of cash if we then reinvest, we actually use our stock to then go buy our competitor. It's cheaper and it's faster and actually much more efficient because you don't have to give up a lot of stock or money to other companies, because even when you go public, other people own a large percentage of your shares, but they immediately sell because you're helping them go public. When you do a reverse merger, you get to have all of those shares that you can then leverage when you go and buy other companies. And so you can make the valuation go higher. Now, the biggest step from there is if you have a company that's public, is you can now sell your company to another publicly traded company. You also have access to something called the capital markets, meaning you have access to money that you cannot get when you're privately held. Simply because you're public, they'll actually lend you more money. Yeah, it's kind of like a bank lending you money when you don't need it. When you need money, they never lend it to you. So when you're public, they're always willing to lend it to you because your stock has a certain value. And of course, the more companies that you buy and you acquire, the higher that stock value goes.
Wow, very wonderful lessons and powerful for any businesses that are thinking to sell or to grow. And this is Mike here. And
check it out. We're happy to help you any way we can.
Thank you very much. Thanks, Mike.
You're welcome. Thank you.